biggest one-day drop in silver maybe ever. And everyone got emotional. People are screaming and panic, and they assume demand vanished. But this is how these idiots work. The very next day, SLV takes in the largest one-day metal inflow in years. Dunnigan, that's not panic buying. That's institutional metal transferring at a discounted price. What I mean by that is that you had 550 million shares outstanding the day before it dropped. The day after, it goes to 587 million. So that's a 36.3 million new shares that were created. Roughly 0.905 ounces per share. That's about 33 million ounces of silver added in one day. And the authorized participants are the only one who can create those shares, and they can only do so by delivering physical metal first. So think about really what that means. Silver gets smashed, and immediately after the smash, tens of millions of ounces show up inside the ETF.
A historic one-day crash in silver prices sparked panic across retail markets, with headlines screaming that demand had vanished. But according to precious metals expert Andy Schectman, the real story tells a very different tale. While emotions ran high, institutional players quietly moved in. The day after the plunge, the iShares Silver Trust RefLV saw its largest single-day metal inflow in years, over 36 million new shares created, representing roughly 33 million ounces of physical silver. Since only authorized participants can create shares by delivering real metal, this signals strategic accumulation, not fear. Smart money often buys weakness, while the crowd panics. Now we present the clips from Andy Schectman's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
The U.S. government that is acting very much like silver is not plentiful. It's acting like it's strategic. Of course, they call it a strategic metal right now. We've had 6 straight years of a deficit, of course. It's been added to the critical mineral list, but now you got this Project Vault, a brand new U.S. critical mineral reserve. It's obvious that they're worried about disruptions, and they call it a public-private structure designed to stockpile essential raw materials inside the United States to protect supply chains. That means they want to incentivize domestic mining also. So you put a floor under the price. And then you zoom out and you look at COMEX registered as the delivery pile, which is massively lower than a few years ago, and the LBMA is being bled dry. Demand is rising, supply is constrained, and the world is treating silver like it's a strategic input. They're admitting this right now. And so I think that, when governments start stockpiling, the message is simple. The scramble for the real stuff has begun. And if that's really what they're going to do, you better clean up your balance sheets if you're wickedly short. Maybe that's what this was about. But I can tell you that nothing changed. There are no fundamentals that changed at all. In fact, maybe they're even getting stronger. And what I mean by that, last thing, and I'll take any questions that you have, the March silver contract is really shaping up to be really interesting. Right now, the March silver contract open interest, meaning contracts that could stand for delivery, is between 80 million and 81 million, right around 80,500,000 contracts open interest. Now, I suppose that kind of sounds abstract until I tell you that each contract is 5,000 ounces of silver. So that's over 400 million ounces of paper silver that is tied to the March contract. The first day that they can stand for delivery is the 27th of this month, so 2.5 weeks away. But if you compare that to what is actually sitting in the COMEX, the registered category as of yesterday is 103.5 million ounces registered, meaning ready for delivery metal is 1 out of every 4. Is that right? 1 out of every 4 ounces. 402 million ounces could stand for delivery, standing against 103.5 million ounces. Now, typically, most of these contracts will roll forward or cash settle, but if even 10% of the March open interest stands for delivery, that's 40 million ounces. If 20% stands, that's 80 million ounces. Suddenly you're looking at a massive chunk of the registered category, and the market has to react. So the bullish bet isn't that COMEX defaults. I think it's simpler. I think that it's the price of immediacy rises, backwardation, the spreads tighten, and the market has to pay up or pull metal out of the eligible category, which is the other side of COMEX, which right now has, 294 million ounces. So we have a Brinks account in New York City, JFK, one of our 8 Brinks facilities. That's COMEX. It's the only one of our 8 Brinks facilities that is a COMEX facility. And we have plenty of people with 1,000-ounce bars in those accounts. Those are eligible. They're not for sale. They could be because they are COMEX eligible. They're in the ecosystem. But no one's going to sell on my side. And all the people that are holding them ineligible, that's not for sale. So even if all of that metal went in, you're talking right now 294 and 103. You're about 99% of open interest right now. And it's all gone. But most of that eligible stuff isn't for sale. The point I'm getting at is that you see what's happening in London. We see that. We've talked to David Jensen, talks about 2 billion ounces of open interest contracts standing against 120 million ounces of physical. You see it right here, 103 million ounces of physical that is standing behind 4 million ounces or 400 million ounces of potential delivery. You see the exchanges being bled dry in Shanghai. You're seeing games being played on the ETFs. You're seeing margin hikes. And all along, the big money doesn't give a flying you-know-what. They just keep standing for delivery. It's the traders who think that they can play in this sandbox with these people who our money doesn't mean anything to them. And you may be very well heeled. You know, our company is very well heeled with the ability to have a massive inventory and the margin requirements needed for it. But if it kept going up, how much can we post? At what point does it just destroy the ability to maintain an inventory? So what they're doing is they're squeezing out the players who think that they're big enough to play in this game. And really what is happening is you are seeing a strategic repricing that is forcing out the speculators and putting it into the hands of the big money who is standing for delivery. What more do you need to see but that? It's painful. It's scary. Fear is a very, very strong emotion, probably the strongest. And when you see this fall, you get emotional. This is why there's Elliott wave theory and Kondratiev wave theory, the mass emotions of the herd. Separate yourself from your emotions and look at the reality. Nothing's changed. In fact, every day it's getting more and more and more obvious that this is where you need to be. Now, what just happened was contrived. It's BS, should have never happened. Where were the stops on the
circuit breakers on the market? Yeah.
The circuit breakers. So they have reasons why it didn't, and they're using the millisecond thing, a bunch of nonsense, right? They stop it when they want. This was contrived. It was done to, I think, probably either at the same time flush out all the speculators and bail out some of the short positions by the big money. You can't keep doing that. When you see this huge arbitrage going on in China, you can't do it. All of that metal will arbitrage away from the COMEX, from the LBMA. If I had to guess, now I'm really stupid to say this, and I'm actually reluctant to say it, but I will say it. If I had to guess, by March, you'll see silver back at all-time highs.
Silver is increasingly being treated as a strategic asset by the U.S. government, with its addition to the critical minerals list and the launch of Project Vault signaling supply chain concerns. After 6 consecutive years of deficits, tightening inventories on COMEX and LBMA highlight constrained supply amid rising demand. The March silver contract shows over 400 million ounces in open interest versus just 103.5 million ounces registered for delivery. Even modest physical delivery requests could strain available supply, potentially triggering backwardation and higher spot prices. As exchanges tighten and margin hikes pressure traders, silver appears to be undergoing a strategic repricing, favoring long-term holders over short-term speculators. Let's get back to the interview.
If you have 5 million ounces of silver that was worth, what was that worth? $500 million? Is that right? Right? Yeah, that would be right. When it was $100 an ounce. If you have 500 million ounces of silver and you're hedging it and the price goes down by $10, how dead are you? And you're never going to get that money back. So you have to hedge it. So one goes up, one goes down, commensurate. And we would normally have 2-3 million ounces of silver in the warehouse. and hedging it. If the price of 2 million ounces and the price fell by $50 or $40, do you see the math? That's $80 million. You're done. You're out of business. You're never going to work again. Well, you have to hedge it. So what you sold short went up $80 million. And it's very costly. So when people say, yeah, can we renegotiate? Understand that we hedge everything and that we're not making more money when the price falls. We're sharing that risk with you. But understand this as well, that all of the logistics in and out and hedging and accumulating and the panic. And I mean, it's magnified at a level I've never seen before. What we did in the month of January, the closest I can explain to it would have been when Silicon Valley Bank failed during the pandemic. And it's the closest I've seen to it. And I know you'll attest to that. So all I would say is that, yeah, people should be patient. Even if they're not working with Miles Franklin, every dealer is experiencing this right now, and it's a good problem to have, but it's very stressful. We're doing the best we can to keep up with it for sure. And so this is with less than 1% of the public invested in metals. What happens, we've talked about the chief analyst for Bank of America, Michael Hartnett, saying you should have 25% in gold, silver. We've talked about the chief investment officer at Morgan Stanley says 20%. Or Jeffrey Gundlach, the bond king, 25% is underweight. Well, if just a fraction of that institutional big money starts to move into this stuff, what we saw here over the last couple of weeks will be child's play. And I think you'll see that. I do. I don't know what will precipitate it, but we're a long ways away from this bull market being over, and the desperate acts that we saw last week, to me, only underscore that. So this is why they say there's no bull market like a gold bull market. When it goes up, people are not letting go of anything because they're reinforced. The market will reinforce their concerns of what's wrong behind the scenes. I don't think we've seen anything yet. So yeah, you're wise to say to do it before it gets crazy. My mind, it is already crazy. I would tell people pre-65 silver is still in my mind. You can get it right now pretty darn close to back a spot. And I just think that there are very few things, even though there is difficulty right now in that side of the market because all the refiners are shut down for now. I think when it comes back online, pre-65 silver is still probably the best value out there in silver. But there's a lot of good values out there. Premiums on things like American Eagles and stuff are starting to go higher again. So crazy market, then again, a very, very crazy market, a very crazy time. But I think we're a long ways away from seeing the end of this bull market, and the actions that we've seen, to me, underscore that dramatically.
The silver market is experiencing extreme volatility, but behind the scenes, disciplined hedging protects major dealers from collapse. A $40, $50 price swing on millions of ounces can mean tens of millions in risk, making short hedges essential for survival. Despite panic and logistical strain reminiscent of the Silicon Valley Bank crisis, demand remains powerful, with less than 1% of the public invested in precious metals. If institutional allocations of 20-25% into gold and silver materialize, today's surge could look minor. Premiums are rising again, and pre-1965 silver coins remain attractive near spot. This bull market, many believe, is far from over. Share your thoughts on his analysis in the comments section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.